It's tough being a central banker these days, who are caught between a slowing economy and a sticky inflation. They raise rates and risk triggering a recession, or they hold or cut rates and they risk letting inflation run out of control. Greetings, viewers. This is Aman Sanga, Independent Financial Advisor in Mississauga, Ontario. For this recording, I'll discuss the central banker's dilemma. And to understand what we are facing with, I'll break this recording into three parts. The first part will use US, for the whole recording, we'll use the US as an example to understand the dilemma that we are faced with. We'll start with the slowdown that's facing the US economy. And second, that we'll look at the inflation that's proving to be sticky. And lastly, I have one investment idea that could work in these given circumstances, provided this is appropriate for your risk profile. So if we get started, before we get started, let's just quickly look at the index returns as of end of day, May 4th. And without further spending the time on all of these, I just want to point to oil. If you look at the change in the last month, it has almost doubled. It was -7 end of March, and it has gone to -14 end of May. And that ties into what is going to follow in the subsequent slides, especially the first part where I talk about the slowdown in the US economy. So if you look at the US economy, there are definite signs that it is slowing down. And the prominent one is, the first one we start with is the PMI manufacturing index. Now 50 is the base case scenario. Anything less than that shows a contraction. And we can see that the PMI is below 50. Second, if you look at the GDP itself, the GDP growth is contracting. It hasn't turned negative yet, but the growth itself is contracting and the inventories themselves have been rising. Lastly, if we look at the yield curve has been negative. So that is a recessionary signal. Along with that, the consumer confidence indication, which is highly correlated to the yield curve, is also negative. So the signs are all there for a recession. And it's, as a leading indicator, these signs are pointing towards an upcoming recession. Now, on top of this, we have a banking crisis in the US, which was triggered by the rapid rise in interest rates and the subsequent mismatch between the assets and liabilities on the bank's balance sheet. Now, despite all this slowdown happening, we find that the US inflation is still sticky. If you look at the numbers, the core is actually more than the total inflation. So despite the slowdown, despite the banking crisis, the US inflation is proving to be too hot for what is comfortable for the central bankers. Now, in this context, with this backdrop, the Fed came out this week and they made the decision to rate the federal fund rates by another quarter point, so which is between the 5 and a 5.25 range right now. And they did indicate that this is potentially a signal to end the hikes for now, but it is all a data-driven process. So we'll have to wait and watch if they hold this. But at this point, they have indicated that there is an end to the potential rate hikes. Now, with this backdrop, where a potential recession could be on the horizon, which would lead to an earnings drop and hence a drop in equities as well, what could be a potential opening for if you are dipping your toe into the market or you have money on the side and you're looking for an investment idea? The bonds are looking attractive right now. If you just look at the 10-year US treasuries, they're hovering very close to the 4% mark, which was just unthinkable even almost a year back, that they could go up so high so fast. And with that, there are funds there which are having a very attractive yield, which they are offering, which is above 5%, which could come into play with a capital gain. So you have a yield on one hand and you have a capital gain on the other hand, in case there is a recession and the US Fed is forced to cut their rates. We are looking at a potential capital gain going on from this positioning. So based on the risk appetite, based on the need for yield, based on allocation available of free funds that could be invested, this is one investment idea that I want to leave you with. With that, I just want to say bye for now. If there are any questions, 905-363-5035. Take care and see you soon.